No, me
Okay,
too.
great. Feel free to jump in anytime, guys, if you don't see something like that. So there's the beautiful mall. That's not the Dayton Mall, but it's a really nice mall. And this is kind of how some of the commercial buildings, we all know this, look now. Um, but anyway, so I got an MBA, and then I went to the Ford Motor Company for about 5 years in Detroit. And after that, I was finalist for Entrepreneur of the Year in Michigan a couple times, and we sold our company in 1997 to a publicly traded firm. And for the next 17 years after that, I've been involved in all types of real estate investing. I've done over 85 real estate investments and exits. I've built homes. I developed a subdivision. I flipped about 60 houses. I flipped a number of high-end waterfront lots, and I was actually on HGTV on House Hunters. And I actually now, as well, am executive director of a nonprofit organization in my spare time. I've been married for about 30 years, and I have 4 children. So that's a little bit about me. Now, I wrote this book called The Perfect Investment. And one of my theses in the book is that if I only would have known all those years, all I know now about commercial multifamily investing, I would have never done anything else. Um, and that's not for everybody, but for me, I've been involved in building a Hyatt hotel. I've been involved in all these real estate things, and I am sure I would not have done anything else if I could have known somehow what I know now. And so that's one of the reasons I wrote the book, is to allow people to get a heads up on the knowledge on the inside track. Now, I'm not the only one in our company who's written a book. My partner, Dr. Brian Robbins, is the author of a new book called Done. And this book is a book for professionals, doctors, and other who want to generate passive income and eventually generate a retirement income from their passive investments. And so Brian has been a serial entrepreneur himself, and he is actually in the process of selling the last of his medical clinics. He's had 6 medical clinics over the years. He's working his way out of that to continue to do multifamily investing. Now, when I sold my company in 1997, I considered myself semi-retired. Now, going into semi-retirement in your late 30s sounds exciting, but it was awful. I was a high-energy entrepreneur. I couldn't sit still. I got involved in all types of other investing that I didn't mention earlier. And I got to tell you that I essentially went back to school again for a number of years. I learned all kinds of things I never did in engineering school or my MBA. And I had a lot of fun, made a lot of friends, but honestly, it's not a school I'd really want to repeat. And that's one of the reasons I co host a podcast called How to Lose Money. On this podcast, we interview successful entrepreneurs, investors, executives who've made mistakes in the past. And I talk about the mistakes I've made over the years, um, because people who have a lot of money have opportunities to invest in ways that the average individual can't even imagine. And they have opportunities to get returns on the order of a higher amount than most people who work a regular job. I could show you how I made well over 100% return on investment using Google AdWords for real estate. Um, Made over $100,000 each flipping, buying and selling waterfront lots at Smith Mountain Lake in Virginia. I could show you how I made a 55% return on investment on a small subdivision I did. But I could also get really depressed telling you about a lot of the mistakes I made, like the penny stocks I bought that were supposed to turn into dollar stocks and they ended up turning into zero. Or the Charlotte, North Carolina entrepreneur I invested with in 1999, and he was showing his investors a 35% profit until the feds caught up with him, and he ended up with 153 years in prison. And he still won't tell his 2,000 plus investors where he hid the money offshore. Um, Swinging for the fences. This is Babe Ruth, and one of the greatest baseball players in American history. And I used to be like him. Babe Ruth swung for the fences. He tried to hit a home run every time at the plate, and he had the greatest home run record in America for many, many years, but he also had the strikeout record. He struck out more than anybody. And my premise now is that if you're a millionaire by the time you're 40, like I was, but you lose it all by the time you're 50, which I didn't, thankfully. But if you do that, you've gained nothing except the opportunity to start all over again. And so I encourage investors not to swing for the fences. I encourage investors not to take huge risks. It's okay if you want to risk part of your investment capital. A lot of investment advisors say maybe 10% would be a good amount. But if you are playing double or nothing with all of your investment capital, sometime you're going to end up with nothing. And then what will you have left to double? So whether you are 22 or 82 years old, I recommend you don't swing for the fences. You don't take risks with your investment capital. There's a law of risk and return. And a lot of people think it means this. You take low risks, you get low return. You take high risks, you get high return. That's what we like to think. But intuitively, we know the truth, and that is higher risks mean higher potential returns. But that means also higher potential losses. I mean, think about lottery tickets. Think about gambling at the horse race. It's a common misconception from optimistic people. And a lot of entrepreneurs, a lot of investors are optimists by nature. And I'm encouraging investors to not roll the dice with your investment funds. If you think investing is gambling, you'll probably not retain your wealth long. I think most of you all know this, but I just like to say it again because as a co-host of How to Lose Money podcast, I hear a lot of stories about people who lost everything. So it's important for all of us to realize this, and it's also important to find opportunities to invest with people you trust, people who won't play with your money, people who won't gamble, and people who will never risk even a dime of your money. There is a common misconception, a common confusion between investing and speculating. I thought for years I was investing, and then I'd wonder why sometimes I would lose money, like on a wireless internet deal that I invested in years ago. The difference between investing and speculating is important. Investing is when your principal is safe and you have a possibility of growing your investment capital. But speculating is when your principal is at risk and you have a possibility of growing or losing capital. And so at this point in my life, in my 50s, I've decided that I never want to speculate again. I just want to invest. It's said that you shouldn't speculate with any cash that you wouldn't mind losing, like kindling in your fireplace. Paul Samuelson, the first American winner of the Nobel Prize in economics, said, investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. When I turned 50, I looked back over my life and I thought, where had I succeeded? Where had I failed? What did I want to replicate? Or what else did I want to run away from? I was tired of the boom and bust cycle that most entrepreneurs had faced, including me. I was looking for something that was stable, something predictable, something that was evergreen that people always needed, something that was not based on the latest war in the Middle East or technology breakthrough or election results or the mood or scandals on Wall Street. I was looking for the perfect investment. I wanted something with demographic trends that I could see into the future that would last the rest of my lifetime and likely through my children's lifetime. I was looking for the perfect investment. And so tonight, I'm going to tell you why I'm investing in stabilized, cash-flowing, multifamily properties in great markets. These are some real headlines from the press. The press has been buzzing about multifamily for a number of years. And so I'm not alone in the conclusions I've drawn. But the question is, what are the demographic trends that have allowed multifamily investing to be as powerful as it is? This graph shows the rise and fall of home ownership since from 1995 to 2016. Now, everybody knows that home ownership in America has declined from, on here you can see 69% to about 63% in the last 10 years or so. But what people don't realize is it just really went back to normal. See, what had happened is the government in 1995 or so got really smart, and they decided that they wanted to tamper with American home ownership. They decided that everybody should own a home. So they made it really, really easy to own a home. But the problem is, after the mortgages were given out too easily, and then when people got tight, people's jobs went away or their income went down, they lost their homes in droves. You all know this. So around the year 2005 or 6, all the way through about 2015, home ownership went in a huge slide. And every 1% decline results in 1 million new renters. The thing is, at the same time these people were entering the rental market during, let's say, 2007 to 2012 especially, there were very few new apartments being built because banks tightened up on their lending restrictions for multifamily and single family. So what happened, there became a significant supply and demand imbalance. And we're going to see in a few minutes a little bit more about why that happened. Germany is already in the low 40% range as far as home ownership. Dallas, Texas is around 50% right now. So we don't know where America will go, but right now it's already down to below 63%. There are 3 major demographic trends that are driving the increase in multifamily housing demand. First of all, baby boomers born between 1946 and 1964, at about 77 million strong, are actually flocking to multifamily housing. It's a smaller group than the millennials in multifamily, but it's the fastest growing group of all. A lot of people, as you know, lost their homes in the last recession. A lot of other people getting older are feeling like renting makes sense, and they're trading in their homes for rentals. And statistics say that when baby boomers begin renting, on average, they'll never buy again. The second large group of rentals, people renting homes now, are millennials. And millennials are the largest demographic group in American history, and 54% are renting. The question is why? Well, for one thing, a lot of them saw their friends, their families, their parents lose their home in the Great Recession. A lot of millennials are disenfranchised with the thought of home ownership. They don't really believe that the American dream is all about owning a home and that owning your home is your greatest investment. Millennials also, on average, want a more flexible lifestyle. They want the opportunity to change jobs, change homes, change cities, go across the country, and they feel like, it may not make sense for them to lock themselves into a contract on a seemingly overpriced home for the next 30 years. On top of that, there's a record level of student debt, and millennials, on average, don't have a very strong propensity to save money. So multifamily makes sense. Access to public transportation's nearby. Some of them don't have cars. They don't want insurance, repairs, gridlock traffic, environmental consequences. That wouldn't have mattered so much 10 or 20 years ago, but those issues are big issues with millennials now. The third major demographic factor is immigration. On the whole, immigration continues to rise in the U.S., as you can see from this graph. And on average, immigrants tend to rent more than own. and especially in the first several years there in the U.S. So this graph shows the risk-adjusted returns of a variety of asset classes. And you can see here that commodities, so the x-axis has the risk, and that's what we don't like, and the y-axis, the vertical axis, has the returns, which is what we do want. You can see commodities are very, very low return and very, very high risk. Small cap stocks have a great return, but also a high risk. If you look at core commercial real estate, you can see that it has the highest return of all and the second lowest risk behind government bonds. Pretty amazing. And within commercial real estate, you've got something that we love, and that is the fact that multifamily investing has has the highest Sharpe ratio of all. The Sharpe ratio is basically a measure of return divided by risk. And so the Sharpe ratio basically measures what the return is compared to the risk. And you can see that multifamily investing is like 4.5 times better Sharpe ratio than the Dow Jones Industrial Average. It's 1.3 times better than private equity, and it's also better than the other commercial real estate classes. This graph is, I love this graph because this shows the difference. This shows what happened in the last recession, the difference between Freddie Mac's measurement of delinquencies in multifamily versus single family. Now, single family is the dotted line, and it shot up to 4% for Freddie Mac loans. Other loans, private bank loans, mortgages shot up to about 9 or 10%. You may have heard that. At the same time, multifamily delinquencies were about 0.4%. So the multifamily delinquency rate was about 90% better than single families in the worst recession since the Great Depression. Now that things have normalized again, multifamily is 98% lower than the delinquency rate on single family. And I want to point out something. This rate of multifamily delinquencies includes high-risk states such as Florida, California, Arizona, Nevada, that actually had quite a few delinquencies. If you factor those out, and you also factor out the mom and pop run shops, the apartments that were not well run, the multifamily delinquency rate is practically zero. And that's one of the reasons that Freddie Mac and Fannie Mae love multifamily. I had a financial planner friend in Atlanta tell me that if you could ever find an investment that went up during good times and also continued to rise during bad times, that would be a perfect investment. Well, you can see multifamily has done that. Based on 1960 index dollars over the last 54 years, you can see that this is the rise in income in the dark line on the bottom. Look at the rise in rents during the same time. Even during the recession, even from 2000 to now, when incomes went down and then flattened, rents continue to rise. And so, and you can see why. Because during the recession, like I said, people were losing their homes. People were finding themselves going back into rentals. And so with very few new rental properties being built during the recession years, the supply and demand balance went way out of whack. And so the demand for rentals went real high. So this is everything that sold me on investing in multifamily. Now, there are a lot of ways to make a profit in multifamily. You can buy duplexes. You can buy rental homes. You can buy small rentals like a 5 or 10 or 20 plex, or you can invest in commercial multifamily. I've come up with what I believe for me is the right recipe to invest in multifamily, and that is passively investing in value-add commercial multifamily with a trustworthy operator and an expert asset manager who utilizes a professional property management firm in a large and growing market is one of the safest, most profitable paths to multi-generational wealth available today. So what I want to do is I want to break down this recipe real quick. First of all, commercial multifamily. That's scalable. That's a large-scale multifamily where you can have your own property management team on site. Yeah, it's generally 80 or 100 units and above. Large and growing market. We're looking for markets where there's a very large buyer and seller pool when you go to buy and sell your property, and also we're looking for a market that is growing, where there's a net population migration into the market, where there's more renters, and there's a diverse economy and a lot of property managers to choose from. Property managers and the right selection of market, we believe, makes up for about 2/3 of the success in any multifamily operation. So we spend a lot of time making sure we get the right property manager. A trustworthy operator. This is basically a syndicator, an asset manager. It's somebody who pulls together all the investors in a group, and then they go out and find a multifamily asset. They run that asset and they give returns to the investors. Expert asset manager, that's usually the same thing. Stabilized properties, we're not looking to buy properties that are vacant or that are all burned out and they have to be re-tenanted. That's an okay strategy, and there's a lot of money to be made in that. But in my mind, that's a high-risk strategy, and I'm trying to avoid high risk. So we're looking for properties that are generally in the 80 or 90 or 95% occupied state. Value add. Now, there's other ways to make money in multifamily, but we really believe that the value add strategy is critical. A value add strategy is this. It's buying a property that has a given known return on investment and meaningfully improving some aspects of that property in a way that the return on investment, the ROI, on the improvements is much higher than the return on investment on the asset as a whole. So if you buy a property with, let's say, a 6% return or 6% cap rate, and then you make some improvements to the property at a much higher return, then your blended average return goes up. There's all kinds of examples of this. There's hundreds. But one is if, for example, in an asset that we're about to acquire, we analyzed their utility bills, and we found out that their water and sewer costs were about 110% higher than they should have been. So we did a little investigation, and we think we found the source of the problem. But what we know is that we can sub-meter this property and put meters in every unit, put meters at the pool, meters in the common areas, and we can narrow down the source of the leaks and the waste immediately. And so we're going to spend about $70,000 putting in these meters, and within days or weeks, we should be able to isolate the leaks, find the waste, and we expect to save about $60,000 in water and sewer costs per year. Well, spending $70,000 to make $60,000 the first year, the second, the third, the fourth, that's about an 85% return on investment. So that investment pays for itself in about 14 months. So the value add in that is the fact that this higher return on investment for that $70,000 pulls up the return on the entire property. And so this is why I like value add investing, because a lot of people ask me, what's going to happen when there's a downturn? Well, if you can drive value, if you can force appreciation, so to speak, at a higher rate than the downturn pulls the potential of the property value down, then you're still ahead. And I could talk about that a lot more, but we don't have time tonight. Right now, I'm going to take a moment to talk about the 4 different types of return in multifamily investing. We call it CAPT, C-A-P-T. Real estate, multifamily, and other commercial types of real estate have these 4 types of return. C is for cash flow, A is for appreciation, P is for principal paydown. T stands for tax benefits. I'm not going to spend much time on this. Cash flow, we generally model for a cash return, a cash yield for investors of about 5 to 10% annually. So this means our investors can expect or hope for a return of about 5 to 10% annually. But on top of that, there's also appreciation. We already talked about that. Appreciation comes in the form of increasing income, and unlike in a single-family world where you're pretty much limited by the comparable properties in the neighborhood. No matter how nice you make your house, it's still going to be appraised based on the other homes in the area. Not so in commercial real estate. The income divided by the cap rate or the return rate is the measure of value. So if we can increase the income on a property from, let's say, $500,000 a year up to $600,000 a year, we just increase the value by that same percentage. But here's the great thing: by using leverage, by using safe debt, it multiplies or it levers the return to 2 or even 3 times as high as the appreciation on the property itself. We expect that we are expecting that the appreciation on a property would generally be in the range of 3 to 9% annually. That's not just the appreciation, but that's the return from the appreciation. We also have principal paydown. This doesn't even sound like a return, but it is, because it's money that's not flowing back to the investors. It's money that's being paid to the mortgage company that's eventually unlocked. I think my favorite benefit is the tax benefits. I don't really like paying taxes. And a friend of mine who's in multifamily from California said, if the American public knew how little we are taxed, we'd have another tax revolt on our hands. Now, I'm not a CPA or a tax professional, but I can tell you a few things about the ways to save taxes with multifamily. First of all of our investors are direct owners in our properties, which means they get all the tax benefits of being an owner. Another one is the return of capital. When we return capital to our investors, let's say we refinance the property in year 5 and we release 30 to 50 or 60% a return in one day, that's not taxed. It's just like refinancing your home. Obviously, you're not taxed when you refinance your home. It's the same thing here. If we give investors, say, a 40% return in one day on top of the cash yields, that money's not taxed. It's a return of capital to the investors. I don't have time to get into this. This is one of my favorite topics. It's accelerated depreciation through a cost segregation study. Basically, it means that we are doing a study as soon as we purchase a property, and we depreciate a lot of the items. Instead of on a 27.5-year basis or a 39-year basis, we depreciate the carpet, the lights, the paving, the landscaping, the appliances, the countertops, even the wiring in the walls and the light switches. We depreciate those on a 5, 7, or even a 15-year schedule, and that accelerates the depreciation. What that means is that our investors are we expect they'd be getting a check in the mail every quarter, and they'd be getting a return on investment every year, a yield, but they'd have a negative number on their K1, a negative number on their tax return for about 5 years or more. And so this is another tax benefit of multifamily. Correct accounting is important. Refinancing tax-free, I told you about that. You all know about deferring taxes through a 1031 exchange. Basically, that means we can exchange a property for another, or possibly exchange one property for 2 later on and increase your position as an investor in multiple properties with no tax consequence. One thing I didn't know when I started in this is the fact that if you do a 1031 exchange and then another 1031 exchange and then maybe even another one, and if you pass away, your heirs, your children at least, will be able to reset the basis. So let's say you put $100,000 in, and then it grew to 200,000 over, let's say, 7 years, and then it grew to 400,000 in another 5 years. And then if you passed away, you would expect to pay tax on almost the capital gains on almost the full 400,000 because your basis will be drawn down to about zero. But the good news is that's not the case. The IRS allows people to reset their basis to zero, reset the basis to the current market value, which means that their taxes might be as low as zero if it was sold after that. So another benefit is the fact that people with self-directed IRAs can invest in multifamily and other commercial assets. As I get close to wrapping up here, I just want to talk about one more thing. It's called quality of life. I was talking to an experienced broker and multifamily investor a number of years ago, and I said, we really want to improve the quality of life at our properties. I said, sometimes there are things we want to do that are just going to make a better quality of life for the tenants. And this guy said, no way. If it doesn't have a clear and measurable return on investment, it should never be done. Well, I don't believe that. We're creating communities here. This is a place where babies are born and children are raised. This is a place where newlyweds celebrate their first home. And this is a place where people are going to get old and live out their final years on the earth. Some things just need to be done because they're the right thing to do. Some fences need to be torn down. Some other ones need to be built. And I could give you hours of documentation on the importance of doing all these things. It results in happier tenants, tenants that stay longer and refer other tenants, higher profits. But that's not even my point. We're not just physical beings. We're created for beauty. We're created to love others and be loved. And as somebody who is a multifamily owner, I'm called to love other people, including my tenants. And by doing that, I believe I'm going to create a place where these boxes called apartment units are turned into homes. And these homes are turned into communities. And so our team is partnering with people who see life through the same lens, people who keep our word, people who really want everybody to win. Multifamily investing is great because everybody wins. The seller wins, especially these days. The broker wins. The investors win. The sponsor, that's a syndicator or an operator, we win. Our tenants win. All of our vendors and employees win. Basically, it's a win-win for everybody. So this is another reason I think multifamily investing is the perfect investment. I want to take a minute as I close to talk about my big why. I don't know how much you've heard about human trafficking, but it's a $250 billion business. Let's put it this way. If you took the record annual profits of Nike, Starbucks, General Motors, and Apple, took the record profits and you added those together and doubled that number, this would be about the number that is the annual revenue generation from human trafficking in the world today. And I just can't sit by and allow this human slavery to happen on my watch. So my desire and our company's desire is to use our profits, to use a considerable portion of our profits to stop human trafficking and rescue its victims. My partner, Dr. Brian Robbins, adopted 7 Russian orphans all in one day. I don't know how he did it, but he's also got a passion to rescue orphans. And so those are some of the things we're really passionate about, some of the ways we want to give back. And that is my big why. I just wanted to let you know that and be happy to talk about that more. So Tonight I made a somewhat arrogant claim, you might think, that I was here to tell you about the perfect investment. We talked about not swinging for the fences, not taking high risks with our dollars. We talked about the demographic trends and the regulatory issues that cause multifamily to be where it is today. We talked about how multifamily is lower risk and higher return than precious metals and stocks and other commercial multifamily or other commercial investments. We talked about how multifamily compares to other types of real estate. And we also talked about the different types of return that were part of multifamily investing. So I really want to thank Naveen and Monique for inviting all of you to the call and inviting me to be on the call tonight. So thank you. I'm going to open up the audio for Monique and Naveen to say anything they would like to say. And I'm also going to open up a little chat box here. So if you can see the chat box on your screen, I would like to try to answer any questions you have. So
that's very, this is Manik. Can you hear me?
Yes.
Yeah, that's very nice of you, Paul, to accommodate us with such a short request and giving an excellent presentation.
Thank you.
Especially like we all have a dream to invest in multifamily, but that doesn't have a clue where to start and the courage, what if we fail, but you narrated your summary of your life in brief, and we really appreciate your education and guidance on this matter. Thank you.
Oh, thank you. I appreciate it. So let's see. There's a few people that said they couldn't get their link to work or their friend couldn't get it to work. And we did record this. Hopefully that recording will be available. And we'll make that available to Naveen and Monique. Somebody said, can you explain some of the challenges on multifamily investing? Yeah. One of the challenges is that it's very, very hard in this market at this time to find an investment that makes sense. Right now, there is a rush of people internationally and from the US who are investing in multifamily. And there's also some training programs, like what I'm thinking of out of Dallas, that trains people to rush into multifamily and to overpay. We have not been willing to overpay. And Wellings Capital is a relatively new company. We've been organized for about a year. And our partner, Brian Robbins, is on the line, but we have another partner, Wade Myers from Dallas, Texas. Wade is the chairman and co-founder of a company called Real Manage, and they manage 200,000 doors in 19 states, and those are in the condo, HOA, and POA space. Wade joined our team, and we found that we all agreed. We were in our 50s. We've all made mistakes in the past. We've all made a lot of money. We've all lost some money. And we decided that we were not going to overpay for an asset. So Brian, Wade, and I have spent the last year looking for the right investment. And we've just been completely unwilling to overpay for the property. And therefore, inside Wellings Capital, the biggest challenge we've had is finding our first asset to put into Wellings Capital. So like I said, I've done ground up multifamily development before. I ran a multifamily project for a number of years in North Dakota. Brian Robbins has commercial assets that he runs now. But inside Wellings Capital, we have not been able to find a single asset that made sense, because every time we go to bid on one, we get outbid. And we're actually we're sad about that, but we're also kind of happy, because it also means that we're not overpaying, and we're not going to have to look at our wives and our children and our investors for the next 5 or 6 or 7 years and apologize because we made a mistake. And that's one of our biggest values. So that is our biggest challenge, and that is finding the perfect asset to invest in. Somebody asked, is this crowdfunding? And if so, how is this different from realty shares, Fundrise, etc.? This is not crowdfunding. This is called a private syndication. So we're not advertising our investments to the public. We could do that. We could change the way we do it, and we could advertise publicly, and there may come a day when we do. But no, this is not crowdfunding. We are the operator. We're the syndicator. A crowdfunding situation, and I think they're great. I think if you can find the right crowdfunding company, it's not a bad thing at all. I have heard some people who have been disappointed with the returns they've got in some, but other ones have done really, really well. But no, we are a sponsor or a syndicator. That means our team, Wade and Brian and I, are actually signing our names on the note. It is a non-recourse note. And by the way, that's another point. Freddie Mac and Fannie Mae have such confidence in multifamily investing that they allow non-recourse loans, which means that's probably too time-consuming to go into, but it basically means that we would not be bankrupt if something went wrong and the bank had to take the property back. We are not personally liable. However, we are signing our names on the loan. We are putting up our own money into these projects. And so that is, I'm trying to read the questions here. I'm sorry. So at any rate, multifamily investing is considered one of the safest asset classes by Freddie Mac and Fannie Mae and these other government agencies as well. Somebody asked, as an investor, does he or she hold the lien on the property, and how does that work? Well, actually, the bank holds the lien on the property. They have they're in first lien position, and then all the investors are actually owners. They're all co-owners of the property. And because they're co-owners, all the investors are getting all the benefits of depreciation, and they're getting the first returns on investment, which means we are paying our investors an 8% typically preferred rate of return. And after that preferred rate of return, we participate. And that's probably beyond the scope of this call to go into any more detail on that. But somebody asked, can you give an overview of how to invest with a multifamily syndicator? So what we like to do is we like to get to know our investors. We want to make sure that they're a fit for us. We want to make sure our investors aren't using gambling language and saying, hey, I want to double my money in 2 years. If that's what you want to do, that's great. Go invest in tech stocks or something like that. That's not what we do. We're not portfolio managers. We're not managing your whole portfolio. We're actually just very, very clear and specific that we're multifamily syndicators. We do Class B, value add, stabilized assets. But if anybody wants to talk about investing with us, they should contact Naveen or Monique, and we can set up a time to talk. Somebody asked, oh, by the way, these are generally, our investments are generally available for accredited investors. Somebody asked, what are the exit options available to the investor? Again, we want to make sure our investors know that we're not like a stock or bond. You've got a kind of a continuum with stocks and bonds on one end and commercial real estate on the other. Stocks and bonds, they go up, they go down, they're not stable. You can't really connect the operations of the company to the return that the investor gets, because it can be based on a war, it can be based on who's in the president's office, it can be based on the next scandal. Like we've seen scandals from CEOs like Uber, and the value of the company, dropped dramatically overnight. So, but they're very, very liquid, and that's a huge benefit of stocks and bonds. On the other end of the spectrum, you've got multifamily investing and other commercial real estate investments where there's a very clear, direct connection between the performance of the asset and the net operating income and the investor's return. It's all traceable easily in a path. It's very steady, very stable, very predictable, but it's not liquid. So the exit options are not clear. If somebody thinks that they really think they want to get in and out of multifamily investing, I don't even know if the crowdfunding companies allow that, but it's not something we would encourage. Now, that said, there are three exit options available to investors. For time's sake, I'll only hit these very quickly. If you're an investment with us, and let's say in year 3 you want out, you have three options. Number one, we can make an offer to buy your shares back. And if you don't like that option, secondly, we can put it out to all the investors in the group. We can tell everybody, hey, one of the investors would like to sell, that they invested $200,000, let's say. You can make an offer to buy their shares. And then number 3, we can throw it open to the public. If you don't like the first or the second offer, you can offer it outside to your friends, to your family, to other potential investors in our group that are outside of that specific group that's investing in that asset. So there are ways out. We would generally expect that anybody who really wanted out could get out, but we don't advertise it that way because it's not considered generally a liquid investment. Somebody asked, is it debt or equity investing? What's the minimum investment, annual return, and hold period? This is an equity investment. We have debt from Freddie Mac and Fannie Mae, and so we're looking for equity investors. We're looking for people who would just be co-owners with us and actually in first position, if you will, to get the returns. The minimum investment is $50,000. There's no guaranteed return at all, but if everything works the way we plan, we expect a 5 to 10% annual return of cash, and then a total return of about 14 to 20% per year. And that total return is the CAP in the CAP-T acronym. That's cash, appreciation, and principal paydown. So we're modeling, like I said, for a return somewhere in the teens, a total return. The hold period is generally 4 to 7 years, but since we don't have a crystal ball, we really don't know if what the interest rates will be like, what the market will be like. We may end up holding shorter if we have a reason to exit sooner and get a large return. We can do that, or we may choose to hold it longer. And that's why it's really important that you're really, really comfortable with anybody you invest with, whether it's Wellings Capital or a crowdfunder or anybody else. Somebody asked here, as Wellings Capital has no properties inside the company, inside the LLC, what assets do you currently hold in terms of cash? Well, all of the individuals, all three of us, have a variety of real estate investments, and we have each one of us has other companies we own. We have passive investments in, and so we each have our own, real estate owned and other companies. For example, I have a company called smithmountainhomes.com. It's a website that generates leads for real estate realtors, and I spend about an hour every week on that. And it's been generating leads for realtors on Google and Facebook for a number of years. Like I said, Wade Myers has a company called Real Manage, which he's the chairman of, and that is a company that has 200,000 doors under management. Somebody asked, where are these multifamily investments? That's a good question. We're looking to invest in large and growing markets like Dallas, Texas, San Antonio, Charlotte, North Carolina. We like Lexington, Louisville, Kentucky. We like Chattanooga and Nashville, Tennessee. We like Birmingham, Alabama. We're looking for Raleigh, Durham. We're looking for cities that have a stability and a lot of net population migration, diverse jobs. We're looking for cities that are not all reliant on one industry like Detroit has been over the years. We're looking for cities generally in the South where there's a lot of population migration to. And we're looking for locations that don't have a lot of instability. And so I hate to tell you, but I know several of you, probably a lot of you are from Florida. We love Florida, but we're actually not investing in Florida because in the last downturn, even though multifamily did really well on average, the rise and fall in values in Florida, California, Nevada, and Arizona was so steep that we felt like that was not an additional risk we want to put our investors through. So while we love to vacation in Tampa, we're actually not investing there. So hopefully that makes sense. We know that if you get in at the right time in Florida or California, you're going to make an enormous profit. The problem is there's no way to predict that right time. And so we feel like that's a risk we don't want to put our families through, and we don't want to put our investors through. And so we are actually not investing in those states. We actually looked at Jacksonville once, and Jacksonville, thought, well, maybe that's kind of not in the same risk category, but we found that their rise and fall in real estate values was very similar to, Miami and other locations in Florida. Somebody said, what are the next steps? I think you would want to get hold of Monique or Naveen and ask them to do a meeting. And I think their mics are turned on, so they might also want to chime in on that. I believe we're actually going to be talking and maybe doing another webinar soon on the current project we're working on. We can't advertise that right now on this call, but I can tell you that we are working on a project in Kentucky. It's in a large and growing market, and we're very excited about that. I'm going to wait and see if Naveen or Monique want to chime in while I read a few more questions to myself.
Yeah, folks, this is Naveen. Once we are through this, we can definitely reconnect either tomorrow or over the weekend, and we can go over some of the stuff. And as Paul mentioned, next couple of days, we'll have a crystal clear idea on the next property that we've been working. Early next week, we would have some data to present to you guys, whoever is interested in.
Okay, thanks, Naveen. Somebody asked what happens if we want to sell the property. Is the multifamily project sold? Is the property sold all in one group, or is it in individual units? Now, it's if there are people who take apartments and turn them into condos and sell them individually, we would not be doing that. We would be selling the entire multifamily property as one group. Let's see. Somebody said, is this going to be a new group of investors, or will this be part of the previous investing group? That's actually a really good question. Our Wade Myers, one of our partners, pulled together a Hollywood movie fund. And he actually, if you would talk to Wade, and you can someday, he would tell you that it's much, much higher risk than that he really loves right now. But anyway, this Hollywood movie fund was a fund that allowed investors to get involved in the first movie, and then they could choose to invest in the second or not, the third or not, the fourth or not. So they're on their second or third film now. And so that is a fund. And we are considering doing a fund where one investor could spread their money over several properties, but we're not doing that now. Somebody asked, in general, how many years does one need to hold a property to make an investment into a positive investment? Well, in the last several years, I know people who have invested in multifamily. I know of a property in Louisville, Kentucky called Heritage Hill. Oh, by the way, we're closely aligned with another company out of Richmond, Virginia, and they have about, I think, 1,500 apartment units under management. They're using the exact same strategy we are, Class B multifamily, and we are working together on projects. Well, so they have a project in Louisville, Kentucky that they bought, and I believe it was in 2013. About 2 years later, they believed that the value, they bought it for less than it should have been sold for. They bought it off market, which is how we're buying our current property as well. And they paid less than they would have expected. About 2 years later, they believed it had gone up in value about $2.5 million. I think they bought it for about $10 million, and I think they thought it was worth about $12.5 million. Well, they got an offer for $14 million. And so they sold that, and it was just a little bit more than 2 years. And so you might think, well, that's great. It went up from 10 to 14 million. That's 40%. Not the case. Because of leverage, they had about a $7 million loan on that. So there was only about 3 million in equity, call it 4 million total, because there was other costs they used to renovate the property and improve it. It actually went up from the 4 million after the sale of the property turned into closer to $7 million. Okay, because like I said, the loan was only 7, they sold it for 14. So these people were actually able to get a very, very substantial return on their money in 2 years. Do I believe that's going to happen to us? Absolutely not. I just don't. I'd love to say it could. I mean, it could, but the truth is we don't expect the frenzy in multifamily to continue forever. And so we're looking more at stable returns. We would expect a project to take about 3 to 4 years to turn into a really positive investment. And that's more like, that's more like a normal investment, stable, moderate risk, low risk, moderate risk, low, moderate return investment. Okay, somebody asked if there are other cases and examples where an investor wanted to sell for personal reasons and the stock or the shares were bought by another investor, and how was that handled by the group leaders? The company that we're closely aligned with has had that happen a number of times, and it happened just the way I said. The company made an offer, and then then they put it out to the group to make an offer, and somebody purchased that property, and somebody purchased their shares. Somebody asked here, do the investors? Yes.
Just a time check. It's 10:07. Are you still good? You want to take more or questions or?
I can take a few more. Is that okay?
Yeah. I'm fine. I just want to make sure you're okay.
Oh, thank you. Somebody asked, do investors have any say in the purchase of properties? No. I mean, if investors want to come to us and say, we heard about a property in a market that we really like, we heard about a 150 unit apartment in Charlotte, North Carolina that could be for sale. My friend has this property. Absolutely. We would love to take a look at it. But investors don't have any, they don't really have any say in because we'll evaluate that. And 9 out of 10 times, we will not purchase the property for any number of reasons, either the market or the property or for some reason. So we make our decisions. We vet every property very, very carefully based on all of our criteria, and most of them don't get purchased. You might also ask, the same person might also ask, do you have any say in the sale of the property? And actually the answer is no. We, as the sponsor syndicator, we have a tremendous responsibility to our families and to all of our investors, foremost, to make the right decisions for all the reasons. So anybody who invests with us is going to really have to trust us that we have everybody's best interests in mind, and that we're going to be making decisions that benefit the investors first and us second. And that's actually in the operating agreement just that way as well. There's not too many more questions. Somebody asked me about past returns on investment. So the multifamily property we built in North Dakota, honestly, it was an anomaly. We built it when the oil boom was starting in northwest North Dakota. We built it quickly, we filled it up, and we were actually charging. These were furnished, these apartments were more like high-end hotel rooms in the middle of the oil boom. And we were actually charging about $3,900 per month for these 300 square foot rooms. And they were fully furnished apartments, but it was an anomaly. It wasn't something that's repeatable. And frankly, I would never, ever, ever take that kind of risk again, because we sold that property for a very, very significant profit. It was $8 million property. We sold it in August of 2013. And the people who bought it from us have not fared so well because, as you know, oil prices went down from $90 a barrel down to a much, much lower number. And so it's just not the kind of risk I would ever take again. Somebody said, is the plan to build multifamily properties or just to hold and rent them? And that's a good question. No, we're not building. I've had my share. I was part of building an office, a beautiful office office building in Colorado Springs, and it happened right before the 9/11 disaster. And actually, that property never has performed as well as it should have, and I sold my shares in that. I don't want to build again. I want to buy stabilized Class B 20, 30, 40, 50-year-old properties that can be improved in some meaningful way and rented out and held. Somebody asked me, how big is the project? I can tell you that the property we're buying right now is about $9 million, and our debt on it is 70 to 75% range. So we'll be bringing in $3 to $4 million in investments. And like I said earlier, in general, the equity investment, the minimum investment is $50,000. Are there any? Okay, that's a great question. Are there any plans to liquidate the investor group after some number of years? Okay, so some syndicators, some sponsors have it in their operating agreement that if they pay the investors after, let's say, 5 years, 50% of their capital back by refinancing, that investor's stake, their share in the property, goes down by 50%. So let's say they put $100,000 in, and we give them let's say a 7% return year in and year out. So that's $7,000 a year on average. Then in let's say year 4 or 5, the syndicator or the sponsor refinances, and they give back the investors about $50,000 of their 100. Now that investor who used to own, let's say, for example, 5% of the property, now they went down to 2.5% because they got half their capital back. We don't do that. We actually do plan to return capital to our investors that way, exactly. But every investor continues to have the same share in the property. We're not buying them out. We're not, in a capital return event, we're not taking away the percentage ownership. Actually, it's kind of the opposite, because what we do is if an investor gets 50% of their money back, we are trying at that time to give them another opportunity to put that 50,000 or that half, that 50% into another asset. 50%, by the way, is completely an example. It's not, there's no guarantees, as you know. So no, we do not buy out their position. Somebody asked, how can we transfer the investment to heirs or others or gift it? Is there any locking period? If somebody is about to pass away and they sell their commercial real estate investment, they're going to have to pay all the taxes that accrued over the years. And especially if it was a long time, that's going to be a lot of tax. If they hold it, though, and they pass away with that asset in place, the value of the asset can be reset at their death to the current market value. And so that's what a lot of financial planners recommend, that people hold their investments like that. somebody, you said, is there any locking period? And I'm not actually sure what you mean. You might mean, is there any minimum number of years that you have to hold it? And the answer would be no on that. I'm not a tax advisor. I'm not a CPA. I'm not a tax attorney. So, you really should check that with your personal attorney or CPA. I'm going to take about 1 more minute to look back through the questions. And let's see. I'm looking back to the top here to see if I missed anything. If I missed your question, feel free to retype it. Otherwise, we'll wrap it up. Naveen or Monique, do you have anything to add?
No, Paul, thank you. Thank you very much.
Yeah, I want to say thanks to you, Paul. And thanks for your time, and really appreciate all the insights you have given. I hope all the audience appreciates that. And thanks everybody for joining us.
That's true. And also in the middle of the weekday, I really thank everybody for attending this call. And have a good evening, everybody.
All right. Thank you so much. I'm truly honored that you asked me to be on the call, and I really hope to talk to many of you in the future. So feel free to reach out to me with questions. We'll send you a copy of my book if you like, or you can order it off Amazon. And I hope you all have a great evening.